Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Bert Salazar here. Welcome to another Cambridge podcast. We're excited today because we're going to be talking about Roth IRAs. And although we've done other podcasts on, the distribution of Roth IRAs and qualified plans, today we're going to spend a little bit of time on discussing Roth IRAs and the 5-year rules. Now, it's critical to understand how the rules apply because this is an excellent product for all of you and all of us to have as part of a retirement distribution planning strategy. Over the last couple of years that we've been doing these podcasts and so forth and seminars and webinars, we're always trying to maximize tax-free retirement income. Now, we all understand that there are three major taxable buckets in the United States. You have the taxable bucket, you have the tax-deferred bucket, and then you have the tax-preferred bucket. Now, the products and the services that go into each and every one of those buckets kind of differ from one another. Now, the taxable bucket is pretty much all taxable. So every year you're going to get a love letter, a 1099, where you're going to have to report whatever gains you had for that year to the IRS and pay taxes according to your tax bracket. Now there you're going to have your savings accounts, your traditional mutual funds accounts, your money markets, your CDs, your stocks, if you decide to sell them and they're under a year, so they would fall under the ordinary rules and so forth. From a taxable perspective, the taxable bucket is definitely not the best. Now, on the other hand, although the tax liability is quite high in the taxable bucket, you do have liquidity, and I think all of us need to have money in the taxable bucket. The key there is to determine what percentage of your assets should be in the taxable bucket, and that will be another podcast I will be doing fairly soon. Now, the second bucket is the tax-deferred bucket. And this is one that most of you and most of us have a tendency to know because, that is pretty much the qualified plan bucket. Now, you may have some non-qualified annuities that may fit in there, but traditionally you're going to have your 401ks, your IRAs, your 403bs, if you happen to work in the public sector or nonprofit organizations. You're going to have your deferred compensation programs. You're going to have your pensions, etc. There, the money that you contribute will be on a pre-tax basis. Then the money is going to grow tax deferred, and then when you take distribution, you will pay taxes on the whole thing. Now, a lot of the issues that we have with clients is that they have, most of our clients have a tremendous amount of money in the tax deferred bucket. And there are some rules that you need to abide by. And again, those are the provisional income calculation rules that we're not going to be discussing today that should dictate how much money you have in the tax deferred bucket. And the reason being is that if you have the right amount, then you may be able to have your cake and eat it too. You may be able to put money in your tax deferred bucket on a pre-tax basis, have that money grow tax deferred, and then because of provisional income calculations, you may pull that money out on a tax-free basis as well. So you get to maximize all three sections of deferrals and distributions. And then last but not least, we have the tax-preferred bucket. Now, this is the bucket that is more than likely the least known bucket to the vast majority of Americans. As a matter of fact, whenever we do tax audits on client investments, we seldom find a client that has been able to maximize the contributions to the tax-preferred bucket or the tax-free bucket. And there are only 4 vehicles that will go into that particular bucket. You have your municipal bond funds. You have your Roth IRAs that we're going to be talking about today. You have your Roth 401ks, and then you have your 7702 plans, which are permanent life insurance plans that can be critically designed primarily as supplemental retirement income. Now, of all the four, the municipal bond funds, the Roth IRAs, the Roth 401ks, and the 7702 plans, there are only three that are totally tax exempt. Roth IRAs, Roth 401ks, and 7702 plans, not only are they tax exempt under the code, but they also do not create a tax liability for your Social Security benefits. Municipal bond funds, although they're received federal income tax-free, the contributions received or the distribution taken will be added on to the provisional income calculation in order to determine, what percentage of your Social Security benefits will be taxed. Now, more than likely, I would say between 3 or 4 times a month, I get calls from clients, and whenever we do audits for clients that are getting closer and closer to retirement, we start to talk about Roth IRAs and the 5-year rules. Now, we normally get questions regarding the distribution rules for our Roth IRAs because they're quite complex and they're not as easy to understand. And by the way, the vast majority of financial advisors in the marketplace are not very well versed in the tax preferred bucket, and therefore they don't pay a lot of attention to how the rules apply for distribution on Roth IRAs and 401ks. Now, personally, I've always thought that the failure to understand these rules kind of prevent many from truly appreciating the benefits of these accounts. Now, for the most part, traditional IRAs are fairly easy. Unless we're talking about non-deductible contributions, the money is deductible when contributed and then taxable upon withdrawal. So whenever you put money into an IRA, you're taking a deduction for the year that you're making the contribution. And then obviously at the end of the road, when you start taking the money out, then you're going to pay taxes not only on your contributions, but also on the growth of that money upon withdrawal. Now, there's also the early distribution penalty that could apply depending on the circumstances. Now, Roth IRAs have a couple of different rules, including 2 separate 5-year rules that we will discuss. The easiest way to understand these rules is to remember that a Roth IRA consists primarily of 2 parts. You have the contributions / conversions, and then number 2, you have the investment gains or losses. Now, this is important because contributions can always be withdrawn at any time, tax and penalty free. Now, the earnings, however, could potentially be taxable and could be hit with the early distribution penalty as well. So let's have a little bit of discussion on something that is called the ordering rules. Now, before jumping into the 2 5-year rules and their examples, I think it's important to understand the ordering rules for Roth IRA distributions. Now, thankfully, I think the IRS created the rules in a way that looks, to benefit taxpayers, so that's a good thing. And that is because the first dollars withdrawn are considered basis. Meaning the contributions, which is always tax and penalty free. Now, if the distribution exceeds the Roth IRA basis or the amount of money that someone contributed to the Roth IRA, then the excess is considered coming from converted funds. Remember, you have the ability to make annual contributions to a Roth IRA based on the tax law and the maximum contributions that you can make. And on top of that, you also have the ability to do IRA conversions. So from that perspective, the excess is considered coming from a converted funds if any have taken place. Now, if you haven't done any Roth conversions, then this is not applicable to you. Now, with conversions, we use the oldest conversion first, thereby increasing the chance that the holding period has been met. So obviously there would not be a tax liability for the client that may have done IRA contributions and also Roth IRA conversions. Now finally, any amounts left over that after the application of the first two tiers is considered earnings. Now this may sound a little bit tricky for most people to understand, but I'll give you an example along those lines. Now, let's talk a little bit about the conversion rule. Now, the first 5-year rule only applies to conversions, and even then, only if the individual is under the age of 59 and a half. That would be the conversion rule. It was adopted to prevent taxpayers from kind of trying to go around the 10% early distribution penalty. For example, let's say I have a traditional IRA and I'm under the age of 59 and a half. If I take a distribution from this account, I pay taxes on the distribution and also trigger the 10% early distribution penalty. However, conversions do not trigger the 10% penalty. So if this 5-year rule didn't exist, I could convert all or a portion of the traditional IRA that I have to a Roth IRA, pay the tax on the conversion, and then immediately take a distribution from the newly converted Roth IRA without triggering the penalty. So I could play those kind of games, and that's why the IRS, created the conversion rule, the first 5-year rule, because they wanted to make certain that, whenever you did a conversion from a traditional IRA to a Roth, you did it for the right reasons and not to circumvent the rules of engagement. Now, as a result of this example that I've given you, converted amounts are subject to the 10% early distribution penalty unless they were held for a 5-year or the taxpayer is at least 59 and a half. Again, let me repeat that. Converted amounts are subject to the 10% early distribution penalty unless they were held for 5 years or the taxpayer is at least 59 and a half. Now, each conversion, it's subject to its own separate 5-year holding period, so that's something that needs to be paid attention to. So let me give you an example. Let's say that John converts $50,000 to a Roth IRA in 2012 and another $60,000 to the same Roth account in 2014 for a total of $110,000. Now, John has not made any other contributions or conversions to the account. Now, fast forward to 2018, and at the age of 50, he takes an $80,000 distribution. Now, assuming no other exception to the 10% penalty applies, John will owe the early distribution penalty on $30,000 of the $80,000 distribution, which would be equal to a $3,000 excise tax for early distribution out of the $30,000 that is now forfeited to the 10% rule. Now, under the ordering rules, $50,000 of the distribution is applied to his 2012 conversion, which in fact has met its 5-year holding period. However, the remaining $30,000 is applied toward his 2014 conversion, which has not satisfied the 5-year rule since we are in 2018. Thus, even though his withdrawal isn't subject to income taxes, part of it will be subject to the 10% early distribution rule. Now, in addition to the conversion rule, let's also look at the qualified distribution rule, which is a second rule that applies to Roth IRAs. Now, the second 5-year rule mainly applies to earnings and determines whether a distribution is qualified or not, and therefore is tax and penalty free. So a qualified distribution is one that paid after the 5-year holding period and one after the Roth IRA owner reaches the age of 59 and a half. Two, after the Roth IRA owner is totally and permanently disabled. Three, to a beneficiary after the Roth IRA owner's death. And four, to a Roth IRA owner for a first home acquisition, which has a maximum limit of $10,000. Now, unlike the conversion rule, this 5-year rule only applies once and is not separately tracked for every contribution on its earning. If you'd recall on the one previously, the client had made a Roth conversion in 2012, another one in 2014, so each of those have a 5-year rule that needs to be applied to. Under the qualified distribution rule, there's only one rule that applies, so therefore the 5-year period begins running as soon as the first dollar is contributed, converted, or rolled into any Roth IRA. So let me give you an example to make it clear for all of you. Again, let's say that John contributed $5,000 to his Roth IRA in 2010 and 2011. Now, he then converted another $10,000 in 2012. And the account has produced $5,000 in earning, giving John a $25,000 balance. Now, he made two contributions in 2010 and 2011, so that's $5,000 each, so that's $10,000. Then he converted $10,000 in 2012, so now the account is at $20,000. And then obviously the account earned an additional $5,000 for a total of $25,000. Now, in March of 2018, John decided to withdraw the entire balance. So at the time of distribution, John is 43 years old. Now the question is, well, if you're 43 years of age and you've gone through this distribution, what happens? Well, number one, he's met the 5-year rule for qualified distribution and the separate 5-year rule for conversions. However, he's not 59 and a half yet. So unless any of the other conditions apply, the distribution will not be a qualified distribution. 2, the first $10,000 is a return of basis and therefore isn't taxable. Remember, the first $10,000 were those $5,000 that he contributed each year for 2 years. Now, the second $10,000 is a return of converted funds and also is not taxable, and it is not subject to the early distribution penalty because the 5-year rule had already applied because he did this conversion in 2012 and now he pulled the money out in 2018. The last $5,000 is the earnings, and those would be subject to both income tax and the early distribution penalty. See, at the end of the day, Roth IRAs provide a number of benefits, and historically low tax rates make them more attractive today than ever before. But like any transaction, make sure that you understand the rules, make sure that you understand the rules of engagement and any potential pitfall before taking the plunge. Now, make sure that as you're trying to do some of these transfers and contributions and conversions, you do have the opportunity to speak to a retirement strategist. Now, most accountants in the marketplace are not very well, they don't have the knowledge and are not very well versed in some of these rules because that's not what they do. So, it's important for you to understand all of the different rules that may hinder your ability to maximize your Roth contributions and your Roth distributions in retirement. And as I always say at the end of every single podcast, our number one goal for all of you is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, if you have any questions regarding any of these topics that we've talked about today and many other of the other topics that we have discussed in the past, please feel free to reach out to me at area code 786-766-1042. My email address is bert.salazar, SALAZAR, at Cambridge, F as in Frank, P as in Paul, LLC.com, or you can simplify to my other business email, which is Bert, B-E-R-T, at bertsalazar.com. Again, thank you for giving me a little bit of your time today, and we'll talk again next week. Take care. Bye.